One of the greatest challenges I faced as a trader in my developing phase, I'm still developing, by the way, or in my early stage of development. I don't think any trader can say they're fully developed, to be honest. We keep learning and growing and developing ourselves each day. The day you stop learning, that's the day you die, right? But one of the biggest challenges I faced as a trader in my early stage of development was FOMO. What is FOMO? The fear of missing out. And why was that a challenge? It was a challenge because I had no prior knowledge that if I miss entering on a trade from my key levels, price could actually offer me plethora of opportunities where I could join or enter the trade and join the move to my ultimate objective. And what did that do for me? It made me lose a lot of money. It made me question myself because you see, you would have a drawn liquidity. Prices ultimately traded to that drawn liquidity, but you're not on the trade. You're not in the trade, and you are beginning to doubt yourself and asking yourself, what is going on, right? And this continued for a while until I began to understand the concept of continuations as a model of its own. So knowing how to spot reversals is not enough. Okay, knowing how to spot continuations is the ultimate. Is also a new layer of development every trader should aim for. So before I continue, I want to say a big shout out to everyone who has been supporting me, who has been liking my videos, watching them to the end, right? Learning, you know, this has built confidence in me to, you know, to create more value for the broader trading community and to share my own 2 cents as we aim towards the ultimate goal, which is to make money off these markets. So understand what I'm going to be talking about on this video. I believe that you must have had prior knowledge on market structure. And if you've not, please go back to the series. I have videos talking about it already on this series, the refined series. And also I've talked about PDRs as well. So this is a concept you must have an understanding of, right? And you also want to have a knowledge about how to spot reversals. I have made a video on how to spot reversals. This was just the last video before this video, which you're currently seeing at the moment. So if you've not watched that video, please go back and watch the video. It's going to help you understand where to look for continuation setups. The next concept I'm going to be highlighting on this series for this video is SMT. I've thrown a little bit of light here and there on SMTs throughout the course of this series, but I haven't really delved deeper into what SMTs is all about. And that is because there are plethoras of content defining what SMTs are all about, or SMT is all about. Why I say SMTs is because there are different types of SMTs, right? There are different types of SMTs. I won't be going over those types of SMTs on this particular video. So I'm going to refer you to GX Trades. Shout out to you, GX Trades, for the wonderful series you're currently working on, right? The first video is a game changer for everyone who has seen that video, right? That lecture has has a lot of value in it and you want to go back and watch it if you've not. So, but on this video, on this lecture today, we're talking about SMT, a little bit of SMT and how it frames your continuation setups. Yes. Okay. So you want to understand when is this continuation setup likely going to hold, when is price going to use this PDRA to send price even higher if you're already on a bullish trend, or when is price going to use these PDRAs to send price lower, to continue to send price lower if you're on a bearish trend, right? And what are the things I want to see in the market that would confirm my bias so that I can get in on the trade even though I had missed out on the initial move. Understanding this is going to save you a lot of money. You're not going to, it will reduce the amount of losses you take in the market and preserve your capital, which ultimately leads to you making more money, right? So, like I said, you want to understand what market structure is all about. You want to understand what PDRAs are. You want to know how to spot reversals. And you also want to have a ground knowledge of what SMTs are all about. So, without further ado, let's drop down to, let's go to understanding what SMTs are. So, on your screen is an image, and I want you to pay close attention to what I'm about to say now. This is going to define and redirect your focus to the real nitty-gritty you need to focus on when you look at the market. And this will ultimately reduce the amount of losses you take in the market, preserve your capital, and enable you become the profitable trader you are ultimately aiming for, right? We are all in this market to make money, and you want to have the right knowledge to help you achieve that goal. In our previous video, we talked about market structure, we talked about how we could use market structure, PDRAs, time, right, to spot places where the market could possibly reverse from. And we also dropped it down to lower time frames to highlight opportunities where you could join the trend from the reversal angle. And in this video, we want to talk about how we are going to build on the knowledge we already have when we discussed about spotting reversals, and reduce the level of FOMO you have going to the market so that you can comfortably and calmly take continuation setups, which is going to reduce the amount of risk you're exposed to while helping you make the most of your capital, right? So the first thing you want to understand that is that SMT occurs between correlated assets. So when I say correlated assets, I mean assets that move alike, right? So we have different, like we have in commodities, we have gold and silver, metals. Those two pairs, they move alike. In currency, on the currency pairs, we have Euro USD, GP USD, and DXY. The three move alike. So that's to say that SMTs occur between 2 or 3 pairs, but these 2 or 3 pairs must be correlated. For the index futures, we have NASDAQ, ES, and YM. YM to mean Dow Jones, ES to mean E-mini S&P 500, and NQ to mean NASDAQ, right? And as you can see in the image right ahead of you, you will see that price is relatively trading low, right? Putting on bearish market structure until price gets into this yellow shaded box. This yellow shaded box is the key level price trades into, and you could see price sweep liquidities resting below this low, creating a new low, and this new low is what sponsors price move out of this PDRA meaning that price rejected off this PDRA and we are possibly reversing from that PDRA. Now, inside that yellow shaded area, which is the key level, there is something I want you to look at. Whereas NQ and ES put on a new lower low, YM put on a new higher low. This crack in correlation is what we refer to as an SMT. Now you can reverse this for the bearish scenario. All right. So a crack in correlation, that is what SMT is all about. And why is this important? You may be wondering, why is this important? It's important because it helps you spot when there is a true reversal likely to form in the market. Because you see, your continuation setups are built on the foundation that the market has reversed. Right? If market was bearish and we have a reversal setup signature inside the key level and price begins to trade higher, that is, market has moved from bearish to bullish. As a continuation trader, you want to wait for price to create opportunities for you to enter the trade. And these opportunities can only be spotted when you know, when you've understood that price has actually started reversing first off. And this reversal is going to last for until your price meets its reversal objective. Now, understanding that you want to position yourself in an area in the market where the market is likely going to tag in your orders and continue trading higher for a bullish scenario, and for a bearish scenario, price continues trading lower. We are going to be going into the live chat to show examples, an example of what I'm talking about. But I want you to understand that SMT is the bedrock for reversals. The key to spotting right reversals is SMTs, right? Like I said, there are many resource materials talking about the SMTs. And if you want, I'm going to drop the link to HTF on the description so you could go watch. He described what the different type of SMTs are. And I believe that if you go back to watch that video, it's going to help you grow and understand the SMTs better, which will inversely or invariably help you understand when to pick your continuation setups. So let's go to the live chat to apply these principles to the charts and see how we could participate in a continuation setup. Well, before we do that, I'm going to go back here and talk a little bit of this. So you want to understand when we are bearish and bullish, that is market structure. If we are bearish overall, if we are bearish, you want to be looking for bearish continuation setups. If we are bullish, you want to be looking for bullish continuation setups. PDRs are so important because you see, in spotting continuations, you want to be familiar with two PDRs for me. And I stick to these two PDRs no matter what. And they are fair value gaps and the breakers. Fair value gaps and breaker blocks. Those are the two PDRs I stick to when it comes to continuation setups, right? And then you want to know how to spot reversals. You talked about that on our previous video. And then SMT, which is what we're talking about currently here. When there is a cracking correlation after price reacts off a key level. Time is also a part of a role, is also a role player to spot the right SMTs. And like I've said already, HTF have created a very comprehensive SMT video we can go and spot to understand SMTs better. But on this video, we're going to keep things simple, easy, understandable, so you can go back to your charts, apply them, and begin to make money of this concept. So without further ado, let's drop down to the live charts examples. So in front of you is the S&P 500 index futures daily chart, and already you could see we will be putting up the bullish price action. We're going to go over what happened already. I used the same scenario for the reversal setup, but I want to show you how you could have entered on the trade if you had missed entering inside of this week, and you just maybe would have been looking for a continuation setup to form the remainder of the body of the candle, right? So first off, it's the same protocol, right? We are bullish, first apply the range high to the range low. There is a discount of the range. Price is reacting off the key level, which is an order block, right here. Okay, now this order block is the key level where price has reacted off of. And if you draw that to the 1 hour time frame, right, this is that key level we just talked about. Then the discount from the range high to the range low, right? Now the question is, we've understood market structure. Price has put on this reversal signature already. The question might be, where is the SMT here? So you could see this 7 o'clock and this is 8 o'clock. And I want you to look at what happened in YM. So in YM, we had price sweep this low, 7 o'clock low here, right? Let me take this off to give you a cleaner chart. So we had price sweep this 7 o'clock low here, and also creating a PSP candle, which is this candle closing bearish. Compare that with the ES, right? Compare that with the ES and the NQ. Okay, they both closed bearish. It's not a PSP candle, but you could see that ES 7 o'clock low was preserved. Now, this would have been a PSP candle if this swing candle closed bullish, whereas it closed bearish on YM. But you could see the SMT formed here, right? SMT between 7 o'clock and the 8 o'clock candle was the SMT that was used to sponsor this reversal higher, right? Now the question is, if I had missed this initial move, right, which was 9 o'clock, 10 o'clock, what could I have waited for to give me a setup for me to join the move higher? As you can see, price only came flipped this high and then reversed. Then ultimately the next leg up came and took out all the resting buy side liquidities above these highs, right? So first, market structure. We are bullish on the higher time frame, right? We have traded into the daily key level, which is an order block here. Okay, so I'm going to write that out, right? We sweep liquidity resting below these lows, right? We have an SMT, correct? Price is moving higher, right? So we missed the first few moves, but now price created a PDRA that could sponsor our move higher, which is what? The fair value gap here. Now I want you to listen. This value gap is the PDRA that sponsored the continuation move higher, right? Now I want you to look at this. As soon as price traded into this continuation gap, I call this continuation gap because it was the gap that was used to sponsor price higher. The question is, if you had taken your buy from here, that would mean you risking over 51 points, right? 51 points. But what if there's a way you could reduce your risk inside of this gap and give you better opportunity to enter the trade without risking so much? So you can see price came, this large candle becomes the new range, right? This large bullish, this large bearish candle on the hourly time frame becomes the new range. Now I want you to compare this with this. Okay, you can see that the 12 o'clock hourly candle closed bearish. Can you see that? It closed bearish on YM, whereas on ES it closed bullish. Can you see the same candle? Now this is what we call a PSP candle, which is also a form of SMT. Now we're going to drop down to the lower time frame to find opportunities where we could have engaged in this price action. All right. Here is the 15 minutes time frame, and this is the low of that big hourly candle you saw on the hourly time frame. Now I want you to look at this. As soon as price swept that low and closed above this candle here, right? This became the order block and confirmed change in the state of delivery, right? As soon as price closed above this big bearish candle, this confirmed the change of delivery. Now, instead of entering from here and your stop loss 51, 52 points, you could have waited for this change of delivery after price have created what? The PSP SMT candle, right? After price has created the PSP SMT candle, price closed above this last bearish candle to create the CISD. This would have been your entry position for the continuation. And you can see we are risking way less now, 26 points, which is almost half of what we could have been risking, which is half of what we were risking if we are taking the full weight of the box. Okay. And you could aim for whatever risk to reward ratio you use for your trades. Okay. But I hope this initial example gives you a glimpse of what we're talking about. We still follow the same sequence. So that's why you have to go back and watch the reversal sequence, because I have highlighted the sequence on the reversal video, right? We're just talking about the continuation here now. You missed this move up here. So what do? You wait. This move up here created an hourly fair value gap, which is this green shaded box here, right? And price traded into this hourly fair value gap, created a PSP candle. This is that PSP candle we're talking about here, which is the 12 o'clock hourly candle, right? 12 o'clock hourly candle is the PSP candle we're talking about here. Now let's drop back into 15 minutes time frame. Here, as soon as price closed above here, this was the end of the 12 o'clock candle, 12:45, right? At this stage, price had broken out, traded above the wick of this candle, closed above the open of this bearish candle here. This is the change of delivery you're looking for. And price just kept respecting the body. You see, the body of this candle. I'm going to zoom out a little bit. Look at how price kept respecting the body of this candle. You see how the wicks the body tells the story, the wicks do the damage, right? The wicks kept closing above the open of this bearish candle. That would have informed you that, okay, we are in for the continuation buy, and that would have given you an opportunity to take the trade higher. All right. So this is an example of what we're talking about. You're following the sequence. and already you already know that price was already trading like this. All this was happening like slightly price traded into the daily open, right? So you don't want to be finding continuation setups way above the daily open, except there is a strong SMT you've seen, right? There are two session opens you could use, the 2-day open and the 2 session open, right? And the 2 session open is 7:30, okay, here. But this the 2-day open, you can see that price is traced into that 2-day open. So price is close the 2-day open for this continuation, right? So you want to also factor in this as well. You don't want to be buying way above the 2-day open for a continuation setup, and you don't want to be selling way below the 2-day open for a bearish continuation setup. I want you to see how this would have saved you a lot of headaches, because you see there was a gap here that you could have used, and if you are taking a trade this from this gap here and you stop loss here, you would have been stopped out, right? You would have been stopped out and you would have felt, oh, what happened, right? These are the things I faced in my developing stage as a trader, right? But now having an understanding of this is going to keep you calm all through the move, and you can join the continuation setup move to the ultimate aim, which was to take out all the buy side liquidities resting above these highs, right? And into this gap here, right? So that is the first. This is the for a buy continuation model. I'm going to show you an example of a bearish continuation model, and we'll call it a day. So here's an example of the S&P 500 creating a continuation setup for us that we could use to further send price lower in this price action. So this is the same example we used in the reversal. So we're going to just go over the little things we talked about already. So this here is the key level, right? Please go and watch the reversal video. This will make a lot of sense to you, right? This is just like a part 2 of the reversal video. So you want to understand what we talked about in the reversal video to understand what we're seeing here. Okay, so the price leaves off here, trades low, right? You did not, let's say you were not in the market doing this move lower, and you wanted to engage and join price as price moved to take out this ultimate objective, which is this low, right? So how would you have participated in this? How would you have defeated FOMO? What setups would you be waiting for? What are the signatures in the price action you want to wait for to continue for continuation setups? Now I want you to observe something. This is Thursday, 13th of November 2025. The next day was Friday, 14th, and the next day was Monday, 17th of November 2025. Now I want you to see that this price action left a gap here. Can you see it? A fair value gap here, right? Now I want you to monitor this gap as we drop to YM. This is the same price action. This is Thursday 13th, Friday the 14th, and Monday the 17th. And I want you to observe how price left YM's gap unfilled. This unfilled gap is a form of SMT. You see, price preserved Friday's high on YM. Can you see it? Y sweeping out Friday's high on ES. As soon as price did this, this was an invitation for us to say, okay, now let's engage. Okay, so we're going to drop down to the 15 minutes time frame, right? The 15 minutes time frame, just to continue from here. How are we going to interact with price after price gave us this bearish SMT signature, which is a fair value gap filled SMT? So dropping down to 15-minute time frame. Okay, so this is the 15-minute time frame. This is previous day's high, which is Friday, right? Then we had Monday open at 00 o'clock here. This is the true day open, right? Price trades high, sweeps Friday's high, right? Creating an SMT with YM. Then price began to retrace lower. Can you observe how price put on this SMT with Friday's high? Price came, broke below this low, which is what? A break of structure, right? So let's assume you missed the move from this high to this low. What do you wait for? Wait for fair value gaps to be filled here. This would have been your continuation, right? This would have been your continuation. Your stop loss above here, right? The only reason why I wouldn't have participated in this is because this was formed during the London session. I'm not someone who trades the London session, but if you do, this would have been where you have participated in price. So the sequence is still the same. What are we having here? This is the daily fair value gap, right? Which is a key level, right? We have Friday's high swept on YM, on ES. Why is this preserved on YM, right? Above the true day open, right? We have price break structure here, right? SMTs to confirm the reversal. True day open, we are above the true day open. That is where the SMT occurred, above the true day open. Price left this gap, which ultimately came back to fill up here, right? Now this would have been your continuation setup as price trades lower to meet the objective. Probably let's do the stop loss here, right? And that's how price traded low to meet the objective, which is what? Sell side liquidity is resting below these lows. This video is not supposed to be this long, but I hope you've understood how to catch continuation setups based on the foundation of reversals. So we do that by waiting for price to interact with key PDRAs such as fair value gaps and breakers. Can you spot the breaker in this price action here? Of course you can. This is the last bearish candlestick before price moved high to manipulate above these highs, creating what? A breaker. And a breaker plus fair value gap is what? We talked about it in the lecture on fair value gaps, right? On breaker blocks. This is a unicorn. Once fair value gap is overlapping with a breaker block, it creates a unicorn, which offers one of the strongest PDRAs for continuation setups. A breaker block plus a fair value gap offers one of the strongest PDRAs for a continuation setup, which is called a unicorn, right? This is called a unicorn, and it's one of the strongest PDRAs we use to send price lower or higher if you're waiting for a continuation setup. So I hope this video, right, opened you up to the fact that you don't have to lose your money chasing price. You just have to wait for price to offer the opportunities for you to join in the continuation setup. And we've highlighted how you could position yourself using gaps, breaker blocks, still following the same sequence for reversals, right? And applying it for continuations. Why are we doing this? Let's say from here, this was just a mere fluke, right? And price decided to trade higher, right? Price decided to mitigate this value gap and then start trading higher. This would have been so risky for you to take a trade on, especially if you don't have the experience to. But waiting for price to break this structure and in trade off of this continuation gap and breaker would have been the game changer for you. See, this is a low risk sell compared to taking from here. It takes experience to always catch the move from the top. But if not experienced to do that, just wait for the continuation and you will still get your own piece of the cake. And I hope this video ministers to your soul. And till the next video, good luck, happy trading. Please like, subscribe, share my videos, leave your comments, and thank you.